The government's going to get you one way or the other.
Right.
And you know, all you can really do in most cases is defer taxation. You can't necessarily avoid taxation. So one of the things that I think we need to talk about are the methodologies of saving money for retirement, because saving money as a small business owner, you do have some unique opportunities there. One thing that we talk to every solopreneur, if you will, just an individual that is an entrepreneur, but he doesn't have any employees, is a simplified employer pension, an SEP program. Think about it as a big, fat, giant IRA account that you get to put more than the average IRA contribution limit into on a regular basis. It's actually a percentage of your profit of your small business.
Yes, and if you're incorporated and not just kind of throwing it on your tax return as a self-employed employee, if you're incorporated, you can put up to 25% of your profits into this account each year. You got to have profits to do that. So again, it goes back to that whole not cutting off your nose, but it allows you to put your dollars back pre-tax so that you can lower your taxable income, but it's saved for you for later. If you're not incorporated, the limit's 20%, so you have a little less, but it's a great tool to defer some of that and make sure that you can keep more dollars in your own pocket.
And true to what we were saying just a minute ago, you can defer the federal income tax and the state income tax on that profit, but you still pay the Social Security tax on that profit. So you still get the benefit of enhancing your Social Security while you're saving for retirement. It really makes double sense.
And the real reason that you pointed out, you're the solo entrepreneur, it doesn't work if you have a lot of payroll to deal with.
That's right.
Because if you set this up as a SEP IRA and you have 5 or 6 employees, you've got to offer them the same deal that you're offering yourself.
Yes. So whatever percentage you're choosing to put in, you have to match that for anybody else who's on your payroll. So if you have, if you're putting in 25% of your payroll, then you have to put in 25% of anybody who's on your payroll as well. And that's only the employer part.
It could get very expensive, and that's why they created the simple IRA, because this is much more like a small business 401k plan. There's very, very, very low cost to administer this. Matter of fact, a lot of the expenses get billed to the individual participant. Where the employer has an obligation is they have to match dollar for dollar up to a very small amount, 3% of the salary of the employee, only if the employee puts in that much. So if you have an employee that's a diligent saver, you can just look at their paycheck and say, okay, if they make $50,000 a year, then $1,500 is going to need to go for that employee's retirement, because that would be 3%. And if they're a diligent saver, the clear thing to do is to at least do as much as to get the company match. So if you just consider what the max obligation of that employer is, it's $1,500 for that $50,000 employee. But if you have the same well-paid employee at $50,000, but they don't save anything, then the employer doesn't have an obligation to match. So it is a participant-driven deal there, but it does afford the employer to save money for his own retirement and the company to make a contribution for his retirement as well. And so there's some double benefit there.
Want more content like this delivered to your inbox weekly? Visit fastest4.com to learn more.